I'm Elliot Koolik. Welcome to Real Estate Today. We're meeting with Neil Stein. He's Senior Mortgage Consultant for WCS Lending. And one of the reasons I wanted to talk to Neil was he is an expert on the mortgage industry. So let's see what Neil has to say. Welcome to Real Estate Today. I'm Elliot Koolik, and today we're with Neil Stein. He's with WCS Lending, and one of the reasons I wanted him to be on the show was to really explain to everybody at home the real ins and outs of what's happening in the industry. So, Neil, thanks for coming on the show.
Thanks very much for having me, Elliot.
Why don't you tell everyone a little bit about your background, and the other thing is you really consider yourself more of a consultant, not just a loan officer. So why don't we talk about that first?
Sure. Well, let me say this to you, that my company, WCS Lending, we closed $1 billion in loans this year and $1 billion in loans in 2005.
So that certainly makes you an expert.
I would think so.
Right.
As far as I go, I have a background, 13 or 14 years, I believe it is, as a financial consultant. I worked in the private client group as a wealth manager at CIBC Oppenheimer in New York. And, you know, probably more than your average loan officer out there, I kind of always talk to my borrower, to my client during a consultation, and what I try to do is I try to get their entire picture. What are their goals? How long are they going to be in the property that they're requiring financing for? And that helps me to see the entire picture.
Well, I think that's important because, you know, with those interest-only products that have been available the last 4 or 5 years, and one of the things I want to talk about in the next segment, which we talked about, was all of those loans coming due, and I think you said it's a few $1 trillion.
That's correct.
But I think it's important that it's not always the short-term solution that makes the most sense for, you know, a potential borrower. And can you kind of talk about that a little bit? Is that, you know, there are short-term options, there are medium-term options, and there are long-term options. How do you see those things, you know, playing into someone's decision?
Well, let me put it to you this way. If you looked at the market for mortgages maybe 1.5 years to 2 years ago, yes, it was very beneficial for one to choose some of the short-term options out there. You had the fixed money, the 30-year fixed money, and the short-term money, meaning these adjustable rate mortgages. There was a big spread between the two. So whatever it cost you to get a 30-year fixed mortgage, you could probably get one of these adjustable rate mortgages for 1 point to 1.5 points lower. Okay. Now, because of the inverse yield curve in the bond market, you've seen that spread tighten up. It's short-term rates that have come up, where long-term rates really haven't gone up that much. So that spread now, what was again 1 point to 1.5 points a couple of years ago, is now maybe only 1/4 point.
Now, let me ask you a question. Do you foresee then that somebody who may be, I don't want to use the word overextended, but maybe bit off more they can chew as far as in a price range maybe they were borderline for, now their loan comes due, maybe they were at an interest-only loan at what, 5%, in the 5s, okay, now it's 6 and change. Should those people be nervous about what's coming down, you know? There's an issue there, right?
Well, Elliot, I'll tell you this much. If they bit off more than they could chew back when they bought their property, they're in big trouble if their loan starts to adjust. Right. Because based on the day they bought their property, their rate for however long till that adjustment was all smoke and mirrors. Clearly.
So one of the reasons, and what I mentioned at the beginning of the show, is why I wanted you on here, is because anybody can get anyone a loan. Correct. I mean, sometimes it's smoother, sometimes it's, you know, it can be a little inefficient, sometimes it can be a nightmare. It depends on who you're working with. But one of the things that is critical to someone is someone buys a house and now the interest rate is 1 point, 1.5 points more. They really need to go to someone who knows what they're doing.
That's correct.
I mean, look, if you have an emergency and you have a medical emergency, you go to the best doctor. Mm-hmm. And in my opinion, when you know, they always say your house is your biggest asset for a lot of people, right? Mm-hmm. So I think it's important not to go to someone that you kind of know, but going to the person that's either been referred to you or really knows what they're doing. So, you know, I think you brought up some very good points. So what does someone do now?
Well, first and foremost, if someone's got an existing loan or somebody is buying a new property, what they need to do is they need to go through the consultation process, okay? And, you know, somebody who's just asking them, you know, where do you work? What do you do? How much money do you make? Do you have good credit? You know, that I don't think is really good enough nowadays. What you really need to do is, you know, compare and go through the different options really based on how long someone plans on being in their property, because that could make a big difference in their monthly mortgage payments. And moreover, I think that people need to be aware of all hidden fees that are possibly in closing costs that a lot of times some of the loan officers out there are not disclosing on the initial good faith estimate. It's very important to have a loan officer that's really a consultant, for lack of a better word.
You made a very good point, and clearly everybody's at a different stage as far as how much they earn, what type of career they're in. So, you know, what I'm about to say may not be pertinent for everybody, but certainly there's a large amount of borrowers that you should be talking to their financial, you know, someone who's managing some of their assets, or you should be talking to their accountants.
That's right.
Just to get a good handle, because, you know, the tax return only says so much. I mean, clearly, you know, taxes are pretty much black and white, but there's more to the story.
Correct. And what I do typically with the borrowers that call me, especially if they're inexperienced when it comes to getting a loan, I will advise them to do a conference call with myself, themselves, and their CPA. As far as the financial advisor goes, that's actually a benefit in working with someone like myself. It's part of what you mentioned, this forward thinking. Yes. I have a history as a financial advisor. So what I can do is, let me give you an example. I had someone come to me about 3 months ago for a loan, and the purpose of the loan was that they were paying a 9% interest on a $500,000 loan in a margin account at a brokerage firm. So I said to them, well, why are you paying 9% interest in a margin account at a brokerage firm when I could get you a 30-year fixed right now at 6.5%? And that was a few months back, and we actually did that loan, and the borrower walked away very happy and very pleased.
Yeah, that's a perfect thing. So let's wrap this segment up, sure. And then I really want to talk about this $1 trillion, this few $1 trillion coming due, and, you know, where we think things are going to go. So we'll be right back with Real Estate Today. Welcome back to Real Estate Today. I'm here with Neil Stein of WCS Lending, and, you know, he calls himself a senior mortgage loan officer, but I really view him as an expert. And I think in the first segment, he really outlined, you know, why his background is so vital for him to be on the show and let everyone at home know what's going on. Neil, what I want to talk about in this segment is, you know, you mentioned, and I think I might have even mentioned it, that $2 trillion of adjustable rate loans are coming due. There's a lot of people at home have a lot of different type of loan products that they've, you know, secured over the last, let's say, 5 years. So what I want you to really talk about is, what is the impact of those loans coming due, and what is the right loan for most people who are purchasing right now? Okay.
That's right, Elliot. There are $2 trillion of them coming due.
Big number.
Big number in 07. And let me tell you, that doesn't even establish the refi boom, which occurred probably 1 and 2 and 3 years later. So you can only imagine what might begin to happen in 2008, 2009, and 2010.
Now, this amount of loans that are coming due, you know, you read it in the paper all the time. Real estate business is slow. Sales are not happening. Is any of that impacting or have an impact on all of these loans coming due, or any new loans that they might secure?
I don't really think so, Elliot, unless it's in the foreclosure market. And I guess that's why I'm here today, to try to help people out there get the right loan for them currently.
Well, you mentioned a great thing, because, you know, I just read it, you know, that the foreclosure rate is higher.
Right.